In this week's video, from a probabilistic perspective, we'll help answer the question, will you be ready for the next inevitable correction in stocks? Was the observable evidence that we use in the CCM market model and the concepts we use, were they helpful during the 2010 flash crash? We'll take a hard look at the period before, during, and after the flash crash, and we'll take those concepts and apply them to the present day. We'll also look at support levels, how concerning are the changes that we've seen in the market from a momentum and bearish perspective, and how do we use all of this technical analysis and all of these moving averages and data. Today's video will make it abundantly clear that maximum flexibility is extremely important and that we don't need to forecast anything. We just need to pay attention and adjust. Since the evidence we have in hand tells us that a bear market does not appear to be imminent from a probabilistic perspective, we'll take the concepts from this January 4th, 2014 article, "You Need a Plan for the Next Inevitable Bear Market," and port them to shorter time frames and look more at rallies and corrections. The concepts that we present in this article and in today's video can help us manage that risk and balance it with the desire to participate in upside. This is the same article on our blog, Short Takes. Why do we do what we do? Risk management is very important. After the dot-com bust, 3 years of stock market gains were wiped out in the bear market. And during the financial crisis, 11 years of gains were wiped out in a very short period of time. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. The main focus of this week's video will be the 2010 flash crash. The purpose is, if we understand these concepts and how to manage through a difficult period such as 2010 during the flash crash, we can use these concepts to monitor the present day market and make sure that we're prepared when the next inevitable correction arrives. This is the S&P 500 index. This is 2010. We'll be looking at a daily chart, and we'll be using moving averages, the exponential moving average, the 20-day, the EMA 40 in red, the simple 50-day moving average in green. The 200-day moving average is in pink. We really won't do much with the 390-day moving average, but the market model uses all of these moving averages and many others as well. We'll focus on these today. In early 2010, we had a pullback, and what we would do and what the model would do is wait for observable improvement before we begin scaling back into the market. This market has to prove something to us with observable evidence. Our market model and these methods are based on the fact that predictions are not only not needed, but they hurt you. So we don't predict anything here. We wait for observable evidence. Here's some observable evidence, an improvement. We have the exponential 20-day moving average in blue. 2 observable and positive things have happened here. Price is now above the EMA 20 in blue, and the slope is up. In the market model, it would begin to check positive boxes as the observable improvement appears. Moving a few days ahead, now price is above both the blue and the red moving averages. In the EMA 40, the slope was negative. Now it's starting to turn up. Observable improvement. Now we have price above the 50-day moving average. We had a flat and indecisive 50-day, but now it has turned up in an observable manner. We continue to check positive boxes in the model. Those boxes were not checked down here. This is observable improvement that we can track answering binary questions, zeros and ones. If our simplified model was just based upon slopes and price, we've now moved to a full bore bullish look. Why is that? Price was below all of the moving averages here, and all of the slopes were down. Now we have the mirror image of that. Price is above all three moving averages, actually 4 and 5 that you can't see, and the slopes now are turning up. What this tells us is the market's tolerance for risk is improving, and the aggregate opinion is becoming more bullish. The risk-reward ratio and the market profile is negative here, and quickly it has shifted back from a probability perspective to a more positive stance. A very important point here is we had observable evidence and observable improvement. If we were patient and we waited for the observable improvement rather than guessing or trying to pick a bottom, we were rewarded. The S&P 500 gained 9% after this point. So this is an additional 9% gain that this simple model would have helped us capture. Notice during the entire 9% gain here, there was really nothing to be concerned about. Price is above all the moving averages and the slopes are all positive. However, on April 26th of 2010, our first yellow flag went up. Instead of just getting a little bit volatile, the EMA 20 now rolled over. We're beginning to check bearish boxes in the market model. We also have a discernible lower low here and a pretty sharp slope here as well. Nothing to get overly concerned about, but the model takes it into account, and the allocations may be adjusted incrementally because we don't know what will happen next. The market may right itself or it may continue to deteriorate. The model doesn't assume what will happen next. It allocates based upon the observable evidence, which is now seeing some deterioration on April 26th. The lower low we just mentioned was actually printed on April 27th. You can see this is a discernible lower low, and we have a lower close here as well. Our slope is rolling over. This slope is still positive, but it looks like it's beginning to hesitate a little bit. This market profile is still not overly concerning, but you'll note we never made a lower low during this move here. So this is starting to look different than this. If we fast forward to April 29th of 2010, now we have a pair with this lower low. We have a more discernible lower high and indecisiveness here in our fastest moving average. Again, this is starting to look different than this. By May 3rd, the observable evidence is now starting to look more like this period here, where the probability of bad things happening increased. By May 3rd, we have another lower high here. We have the blue moving average clearly rolling over with price below it. We also have the red EMA 40 rolling over with price below it. You'll notice during this entire high probability advance, none of that occurred. This market profile from a probabilistic perspective is clearly deteriorating by May 3rd. The market model would not be checking positive boxes related to some of these questions now, and hence would begin to incrementally move away from risk. Why do we incrementally move away? We don't know what will happen next. If the market rights itself, that's fine. We have a little bit of cash, we can redeploy it. If it continues to deteriorate, especially for any length of time or severity in terms of magnitude. We've taken a step away. We can take another step away if things continue to weaken. By May 5th, more observable and bearish changes to the market's profile. Now we have price below the 50-day moving average. Here, price below green. This is the first time we've been below the 50-day moving average since just prior to scaling in heavily here in early March. Here, now, instead of looking like this, it looks more like this, where from a probabilistic perspective, weakness followed. The flash crash, this drop here, occurred on May 6th. On May 7th, we had a little bit of a bounce. So for those that say there was no observable evidence or warning prior to the May 6, 2010 flash crash, the evidence says otherwise. There were 1, 2, 3, 4, 5, 6, 7, 8 different forms of observable evidence, and that's just using this simple model. We're showing you this model because these concepts apply to many of the other charts, indices, and risk-off, risk-on ratios that we look at. We use diversification, so in our model, we saw a lot more than what we're seeing here. To give you an indication of that, in addition to using these, we also look at multiple time frames, daily, weekly, monthly, and use a wide variety of indicators and measures of market breadth. Therefore, if we saw 8 forms of observable deterioration in the market's profile prior to the May 6th flash crash, you can be assured that weakness also showed up on other time frames and via other indicators, all tracked by the CCM market model. Our purpose here is not to imply that the CCM market model or this simple moving average model would have helped anybody avoid the flash crash. Our models and this simple model would have lost money in this period here. However, they lost less than if you were fully invested. If you start scaling out based upon the observable changes, when the flash crash comes, your allocation to stocks has been reduced, and your allocation to more conservative assets such as cash or bonds has been increased. It should also be noted that May 6th alone is not the only problem that we have here. After this bounce here on May 11th, we still have a concerning profile. Negative slope, price below, price below. We still are concerned here on May 11th. We need this market to prove to us that we should scale back in. We need this to turn into something more like this before we get confident. If we would have jumped the gun on May 11th and reinvested our cash using a forecast that this bounce would be sustainable, we immediately would have gotten negative feedback as the stock market dropped on May 14th. You can see here on May 14th, negative evidence and more significant negative evidence continues to pile up. Now we have a bearish moving average crossover where the fast EMA 20 has now crossed below observable evidence the red EMA 40. Notice this is the first time this has happened since this period here. This is a worrisome look, and additional weakness did follow. This is the first time blue has been below red since this bullish moving average crossover as we scaled in and captured these gains. Another common misconception about the flash crash, and anyone that used a back-tested and disciplined model to deal with it, the flash crash was not a one-day event. You can see here on May 17th, we're still 49 calendar days away from the final bottom and shakeout after the flash crash. You can see the observable evidence here, 49 calendar days before the bottom, is significant. 50-day moving average rolling over here. We have our bearish cross. The slope of the red moving average down. Slope of the blue down. Price below red. Price below green. Price below blue. And now price is below the 200-day moving average. On May 17th, 49 days before we bottom, the observable evidence is having us scale away and continue to reduce risk. We need this market to show us with observable improvement that we should put our capital back in harm's way. Was scaling away based upon the observable evidence a good idea? Oh yes. The stock market lost 13.3% from this period here to this period here, which tells you the one-day flash crash event was not the only thing that we had to contend with. We also had to contend with a market that dropped from May 11th and didn't find a bottom until July 2nd. The first yellow flag came 68 calendar days before the bottom in the form of this lower low and this indecisiveness here back on April 26th and April 27th. Again, the market doesn't bottom until July 2nd. A big part of the market model, in terms of its design and its approach, it's designed to protect our confidence. When you move away in an incremental manner, your confidence is protected. When you get this big drop, if you've already sold for several days, you're getting positive feedback for those decisions rather than negative feedback. When you get this plunge here, you have positive feedback because you've made good decisions here. And when the market gets all the way down here, instead of having your confidence being destroyed with big losses and the fact that you knew you should have taken some action and you didn't, your confidence is high here and you're open to redeploying your cash when you see observable improvement. After a period of consolidation and indecisiveness, which was really highlighted by a flat 200-day moving average, this flat 200-day moving average tells you that the stock market is on the ropes here. Real improvement was observable here. We get slopes that are up, blue above red, red above green, price above all of them. And now price has recaptured the 200-day, and you can see here on this day, the 200-day moving average ticks up slightly. The model, by rule, has to scale in here. We've got a full bore bullish look here, which was similar to this full bore bullish look. Price is above all the moving averages here, and the slopes of all of the moving averages are positive. Price is significantly above these moving averages, above the 200-day, and the slopes of all of them are positive. From a probabilistic perspective, this look here is much, much better than this look here or this look here. Just as following the rules religiously here helped us protect capital, following the rules here religiously, even after some whipsaw action and indecisiveness, we were finally rewarded. After all of the observable evidence is bullish, after this, I can see the observable changes. I'm not predicting anything. I'm allocating based upon these observable changes, and the stock market gained 21% from this point here prior to peaking in April of 2011. Two valid questions from here. How does this help us today? How do these moving averages look today? And what does it tell us about the state of the present day market? Another valid question, which we'll address first, is how do we use all this? As we wind down this week's video, we'll take these concepts, these moving averages, and look at the present day chart of the S&P 500 in 2014. We'll compare the slope of the 200-day, the 390-day, the EMA 40, EMA 20, and the 50-day here in green to this period here and this period here. How do we track all of this information and convert it into a usable format? These are screenshots where we answer the binary questions. Is the slope of the blue moving average positive? Is the slope of the red moving average positive? These are all of the questions that we just looked at on the weekly charts. If the answer is no, it's a 0. If the answer is yes, it's a 1. We also look at hard data, which is unbiased, and we use bullish and bearish hurdles. All of this is used to get a handle on the current market profile and or tolerance for risk. This is observable, hard evidence that helps us understand what the current market profile looks like, and then the master market model compares it to historical profiles and recommends an exposure to risk assets such as stocks and conservative assets such as bonds. S&P 500 daily as of the close on Friday, January 3rd. You can see the slopes of the long-term moving averages are much healthier than they were in 2010. This tells us that the long-term bullish economic conviction is much better than it was in 2010. We really don't have anything from a concerning perspective that shows up on this simple model. We have price above all the moving averages. The slopes of all the moving averages are up. Blue is above red and green. Red is above green. Slopes strong here. If you're a CCM client, you may ask, why did we take a small incremental step away in some accounts on Friday? The market model uses numerous inputs, not just this, and we have seen some relatively tame and mild observable deterioration, and we don't know if that slowing momentum will take this look and have it morph into something more like this or this. If the market steadies itself from what is a relatively bullish profile, then we're fine. We still have a high allocation to stocks. In terms of how we use this next week, we'll keep an open mind. And if the observable evidence from the present day morphs into something more like this or this, we'll continue to step away at a rate in line with the observable deterioration. We'll wrap up with some simple support levels that we'll be watching next week. You can see this pink line here has acted as resistance, resistance, support, support, support several times, which tells us that the market cares about this slope. If I take a parallel line and move it here, it appears as if the market still cares about this slope. Resistance, here we have a bullish breakout, and we appear to be retesting that level, which sits at roughly 1827. So if 1827 holds and we make a higher high here above 1850, it would improve the probabilities of this being a successful retest of this bullish breakout. If 1827 doesn't hold, this high here is 1813. This low here is 1801. This appeared to be important to the market before. If these don't hold, we can come down into this area here, which is near 1775. There's numerous areas of possible support which tells us to keep an open mind about buyers stepping in anytime between this level here and this level here down at 1760 on the daily chart of the S&P 500 index. We will try to post some updates about these moving averages and support levels that we've covered this week relative to the present day as things change on Twitter. You can also follow us on Facebook via our blog Short Takes or our weekly videos on YouTube. More information about the CCM market model can be found on our website. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shervacco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.